Now then, let's do one of these interesting little chart data-driven numbers that we like dealing with on this program. Barely a week ago, on the 6th of May actually, Bloomberg reported that Western Union had been in talks to acquire its smaller rival, MoneyGram. Now, the 6th of May, after MoneyGram shares had shot up by as much as 41%, Western Union representatives came out and said, no, actually those reports are not accurate, they're not in talks, they're not interested in buying out MoneyGram. Nonetheless, there's a fairly good reason to explore the merit, or in this case, the lack thereof, of such a deal. You see, in the last quarter of 2014, the global average cost of sending about $200 anywhere in the world was about 80%. But if you're sending money to this continent over here, it was actually way higher. That was about 12%. Now, keep in mind, however, that it actually does get a lot worse if you're within Africa. A 2014 study by ODI pointed out that if, say, you're a Ghanaian living in Nigeria or Mozambican living in South Africa and you want to send money back home, the transaction cost would rise to at least 20%. It's a staggering number. Now, that exact same study also pointed out something equally disturbing. Between them, these two companies, Western Union and MoneyGram, control up to 67% of remittance flows to Africa. Now remember, we're talking about roughly 30 or so billion dollars a year since 2012, and that figure keeps rising. Now, it's market concentration on that scale, which ODI argued last year, that allows these two companies to rake in over $586 million through what essentially are described as opaque foreign currency charges. Now, as dismal, as disturbing as these numbers do look, there is one slice of good news for you if you're sending money back home, and it lies in two concurrent developments: the rise of mobile money use across Africa and increasingly higher mobile penetration rates right across the continent. As Ismail Ahmed, the CEO of WorldRemit, told me earlier on, these two developments are enabling more and more African migrants to sidestep these two companies altogether.
There is an audit trail. Starting when a customer goes to our website or downloads our app. So, and the money is often coming from a bank account, whether it's a card or bank transfer. Compared to the traditional model where someone takes cash, goes to a corner shop, and you don't know where the money came from. And even, somebody going to a corner shop could be using even a fake document to show to an agent. And often in that context, the agent is not a staff member of the principal or the company. It is somebody who's doing this as a side business. Mm-hmm. So historically, there has been a lot of challenges in terms of terrorism financing, money laundering within the cash-based model. But in the online setting, yes, the money is already coming from an account where the bank must have done a KYC. And on top of that, it's easy to do electronic verification in a lot of the send marketers. So you're dealing with somebody who is opening an account, becoming a regular customer. You understand their profile. You do transaction monitoring. And then in the receive side also, where we have done more than any other company in terms of digitizing the receive side. When the money goes to a mobile wallet, there is then again an audit trail which shows how the recipient is using the money.
Picking up on that point, though, the World Bank, in a report issued out in April, indicated that the use of mobile money in cross-border remittances, especially within Africa, is still fairly limited. I mean, the value of international remittances going through mobile phones accounted for less than 2% of global remittances in 2013. What is the problem here? Why are more companies and more people not sending money through mobile phones and essentially avoiding the whole anti-money laundering, terror financing risks that entail with that come along with cash pickups?
Things have changed dramatically in the last year and a half. We see a big chunk of international remittances, particularly to Africa, going through mobile phone, going to mobile wallets. And Kenya was one of our first corridors. And today, close to 90% of our transactions are going to M-Pesa. A lot of the banks that work with money transfer businesses like to see digital transactions in the receive side as well. So with that shift is started now, and we see that shift accelerating.
Could mobile money then, in that sense, be perhaps the silver bullet, as it were, to solving the problem of sending remittances from, say, the UK and the US to Somalia?
In Somaliland, that is what is currently actually happening. So there is a mobile money service called ZAD, which the GSMA says is one of the most successful mobile wallets in the world, because in that wallet, customers don't cash out. They use the money to pay for goods and services. So in the capital, Hargeisa, today, anybody taking a bus would be able to pay the fare or through the mobile wallet. And so hugely successful. So international now remittances are increasingly going to that wallet now, which is connected to MasterCard's HomeSend platform based in Belgium. Mm-hmm. So a lot of companies like us are connected to that hub, and so we think in many countries of Africa, in many countries, the mobile wallets could become the solution and could address some of the concerns about the audit trail. Where is the money going to?
That's part of my conversation earlier with Ismail Ahmed, the CEO of London-based WorldRemit.